Thanks a lot for joining this today. So my name's Freddie. I'm an associate at a VC fund based in London called Smedvig Capital. We invest at Series A and B in European tech companies. And I'm in the investment team, so spend the majority of my time looking at new investments and working with companies we back. Over the next sort of 50 minutes or so, a bit less, I will give some background on Series A rounds, Series A investing. So things like what a Series A is, how long the process takes, how to choose investors, things like that. And after that, I'll talk more about who we are and what we look for. I'm just going to share my screen with a few slides I'm going to talk through. So to start with, what is a typical Series A? So simply, the Series A is the round that follows the seed round, and people define the series as slightly differently. But Series A investments are typically sort of 2 to 10 million check sizes in exchange for about 25% ownership for the investors. The valuations of Series A companies are usually somewhere between 15 and 40 million. Sometimes in the news, you'll see valuations a lot kind of north or higher than that, but they very much are the exception. Most valuations are kind of in that range. And a Series A round usually happens something like 1 to 2 years after the seed round. And when we say, kind of quickly on this, the definition piece, when we talk about series, the Series A versus D or whatever it might be, series is really just a proxy for investment risk, because the businesses are more and more sort of proven as you progress through those stages. And in my opinion, the crux of what is driving that change in risk between a seed investment and a Series A investment is really product market fit. So at Series A, unlike at seed stage, we look for clear evidence that the business has product market fit and is already adding real value to customers. And that's really, I think, what the crux of the difference between a Series A and a seed round. We can touch more on what kind of product market fit really means. It's kind of quite a nebulous concept, and happy to kind of dive into that in more detail at the end. But that's really the crux of it, in my opinion. It typically takes sort of 3 to 6 months to complete a Series A. And kind of on this slide, you'll see I've outlined some of the key steps of the process, which are kind of driving that number or are the reason why it can take as long as that. And I can dive into these in more detail at the end. But as a result of that, or kind of given it takes 3 to 6 months, we reckon companies start thinking about and planning their Series A well before this, really, maybe as much as sort of 12 months before they think they want to close. When it comes to kind of deciding who to raise a Series A from, there are basically are two options in terms of types of entities you could raise money from. The first is just the VC funds like Smedvig, and that is the majority of capital going into Series A investments does come from VC funds, probably something like 90%. And then the other option is corporate VC, which is the venture arms of kind of large corporates. Some of the kind of famous ones you have kind of CVC arms are Google, Intel, Salesforce, kind of companies like that. And CVC activity has grown kind of quite a lot over the last few years, but it's a relatively small percentage, something like 10% of Series A funding. And a quick comment on the difference in raising between those two. I mean, CVCs can add a lot of value through kind of connections and industry expertise, and that's typically what, when a company has decided to raise from a CVC, that's probably what they've kind of interested in or excited about. But on the other hand, you can get kind of conflict issues where customers or future investors are maybe put off by the corporate and stuff. And so sometimes there can kind of be conflict or incentive issues. A kind of third bucket of funding for Series A kind of companies is venture debt, but that's not really, that wouldn't kind of be for sort of normal Series A. That would typically be used to kind of bridge between rounds and stuff, and usually a bit later than Series A. So meeting VCs, well, there's basically three high-level bits of advice that I think we have when it comes to meeting VCs. The first is research the VC and make sure they're the right fit. That's both in terms of kind of the parameters that they invest with. So kind of by that, I mean, each fund may have certain conditions that kind of need to be met for them to invest, such as kind of a revenue threshold or things like that. So make sure definitely there's kind of fit in kind of that sense, but also kind of culturally, and make sure there's sort of what we call VC founder fit, because it's crucial. The second thing is, where possible, try and get a warm introduction. Typically, well, we get a lot of warm introductions, I guess, through some of the seed funds we know well, and that's probably the most common way we get a warm introduction to a prospective company, prospective investment. But we also meet lots of companies that contact us cold or who we contact cold, and that's absolutely fine. And we absolutely look at every deck that is sent to us. We will always do that. So yeah, that's also absolutely fine. The kind of third general bit of advice is to have a kind of concise, what we call sort of teaser deck, which summarizes the business and your vision for the business, and also ideally has details on kind of your growth, the market size, unit economics, competition, and the team. So when choosing an investor, if one is in a kind of the fortunate position of having a few options, or I guess even at the stage before this where you're deciding which investors to reach out to, there are a few key things that we would recommend asking investors, and also I guess yourself. The first is, how good is their reputation? So, and the best way to really do this is to try and speak to people who have worked with that fund, and ideally also the specific partner who's leading the deal. That's really the best way to work that out. There's obviously information online, but I think speaking to someone who actually knows that fund well and has worked with them, I think is the best way really to understand that. And the second thing is, do they have money to deploy after this round, and will they actually be able to follow on? It's basically very important, and a key thing there is about what stage they are in the fund journey, and whether you're kind of is this like the last investment they can make from their fund, or actually kind of towards the beginning of their fund, because sometimes there can be issues there. If you're at the end of the fund and they don't raise another fund, they may not have kind of capacity to follow on, and that's very important. The third thing is kind of, do they roll up their sleeves if and when you need it? Whether that is important to a founder it will depend a lot on the founder and what they're looking for. And I guess we would also encourage founders to think about what type of investor they want in terms of the involvement that investor takes on. The fourth thing is, do they have experience kind of in your sector and with your business model? Because there's likely going to be a link between the kind of strategic value add and connections they can make and their experience in your sector or with your business model. And finally, I would ask myself, if I was an entrepreneur, would I be happy working with this fund and these people for sort of 5 to 10 years? Because it's a very long relationship, and a partnership really, and it's just crucial to want to work with these people. So I would definitely ask myself that. So it's kind of a bit of further background on us and Smedvig. We invest, so it's sort of Series A, B, and specifically sort of 2 to 15 million check sizes in European tech businesses, primarily in the UK and Nordics. we've invested over 400 million across 72 companies over almost 25 years. It's our 25th anniversary next year, so we're a relatively old fund in the market. There are 15 companies in our portfolio at the moment, which you can see at the bottom of the slide. And you can see they're kind of across a range of sectors because we're broadly sector agnostic. There's a couple of sectors which we don't invest in, like cyber and pharmaceuticals, because there's some areas where we think you really do need kind of very deep domain expertise to invest in. But other than that, we are sector agnostic. This chart kind of just showing what a sort of typical year looks like from the investment team at Smedvig. We see something like 800 deals a year. So those are deals that kind of come to us either through kind of via contacts or that we reach out to, or which in some way we are aware that a deal kind of might happen in that year. Of that 800, we would have a first meeting with 100 or so. Of that, about 30 progress to a stage where we write what we call a one-pager, which is just an internal memo on the opportunity. So it's basically just the kind of summary of the business model, the founders, and a kind of bit of analysis using some data that they've sent across. After that, about 5 to 10 get to a stage where we make a more in-depth memo, which we kind of call the multi-pager. And that's where we've done a lot more analysis and spent a lot more time with the founders this is a pretty late stage. We've kind of done a lot of analysis, and we're very excited usually by the opportunity at this stage. The next stage after that is the term sheets, and we typically offer 5, or a typical year we might offer 5 term sheets, and of that 2 to 3 might be accepted. So in terms of what we look for, I think it's something which is basically quite reasonably simple to articulate, but just quite hard to find. And I would split it into these 5 buckets. The first is just a great product that is differentiated and defensible and has clear product market fit. The second is fast growth. And now what fast means depends a bit by stage. I guess at kind of an early Series A, where a company might be doing 1 to 2 million revenue, I would say probably rare to raise a Series A if it wasn't growing maybe north of 50%. And we certainly see a lot of things that are growing a lot faster than that, particularly the sort of early A. The kind of late A, maybe kind of a bit less than that. But growth is crucial. And the reason why growth is important is for 2 main reasons, really. One is it's a very good or pretty good signal for product market fit. So if a product is genuinely differentiated, defensible, and adding a lot of value to customers, it in some way sort of should be flying off the shelf. And now that there are reasons why it might not be, which don't mean it doesn't have product market fit. But a lot of the time, if it's proving difficult to sell, it raises questions around product market fit. The second sort of reason why growth is very important is the companies we back basically just need to grow a lot to justify the valuations in question. If you remember on one of the earlier slides, the average Series A valuation is 26 million. And if the company's only doing 1 or 2 million of revenue, they just need to grow a lot to kind of get to a stage where the valuation is kind of significantly north of that. The third thing which we look for and which is crucial is the team, and a kind of an exceptional team who are experts in their field. A lot of investors and us will kind of ask things like sort of why you and why are you the kind of best placed person to solve this problem? And what we're always just trying to dig into that, like why is this team the best placed team there is, or best placed person out there to solve this problem and really kind of solve this problem in the market. The fourth thing we look at is the unit economics. So what we're looking for here really is evidence that the business kind of can be profitable at scale. We very rarely see, it was very rare for business we look at for them to be profitable at this kind of current point in time. But our analysis on unit economics helps us understand whether they can be profitable in the future, basically, or helps us understand the extent to which they can be profitable in the future. The last kind of key thing we look at is the market size, because at the end of the day, you could have all these 4 ingredients, but if the market is just very small, it will be very hard to reach any kind of significant scale. So the market size is also is crucial. To find out more about Smedvig, there's we're kind of pretty active across various channels. The thing I would flag is we have a series kind of articles on our website and on Medium called Navigating VC, where we there's a kind of a lot of details on basically the Series A process, some of the details of which I've touched on. Thank you. And yeah, look forward to any questions. Can people hear me now? Sorry, guys. I was just saying I will share the slides. That's not a problem. And yeah, that's basically the main question. There's a comment around unicorns with revenue of £1 million from Paul, and I think it doesn't surprise me. And I think I've seen similar things. It's very rare though. It really is the exception, and there will often be very specific reasons why that is the case. It may be that the founder there is particularly high conviction that founder can deliver what their vision is, for kind of a very particular reason. But it very much is the exception, those kind of numbers. But they obviously they make headlines because of that, and I think but in reality the vast majority are just kind of don't look like that. I think those are, just kind of flicking through, these are all the questions, guys. Okay. Oh. So, a question from Pari. Yes, I mean, let's. I don't know if you can get my email or someone from Bristol Tech Festival, but happy to have a discussion on that. Yeah. Yeah. Okay, guys, I think that's everything on questions. Okay. Yeah, thanks for joining, everyone. Thank you. Have a good evening. Oh, sorry, there's one last question. The majority of our leads, I would split it. The main two sources are basically seed funds who we have kind of good relationships with, and they introduce us to or recommend we reach out to their portfolio companies, and that's a big source of our leads. The other one is basically our kind of internal outbound effort. So basically, we use software to pull a list of companies that have raised basically seed investments at some point in the last few months, and that kind of gives us a huge volume of companies that may potentially be raising Series A at some point in the next 1 or 2 years, and we kind of systematically go through that list, deciding which ones to reach out to. And I'd say the majority of the companies we meet comes from those two sources. There's other things like brokers sometimes introduce us to companies, and we might like read about a company in kind of on a news channel or something, and then reach out. But the majority are those first two sources. The quick answer, basically, Alex, is yes. So, and we are basically very close to, as in we have kind of done all our due diligence and are very late stages of a new deal, which hopefully we'll be able to announce at some point in the next couple of months. So we are now investing again, and the appetite for investing now is there's no change really. And we're seeing that in the market. I mean, when I've kind of spoken to people at other funds, people seem to be saying that kind of activity is broadly back to normal now. I think, and it's one of the good things about venture investing is the stuff we're investing in is it's such long-term investments, and we are investing in things which basically will take a long period of time, take many years to get to where I think we can get to. Short-term things like what's currently going on at the moment is in some ways a bit immaterial to that. So it's kind of one of the fortunate things about venture really there.